The next panel discussion is Global Economic Trends, What to Expect Over the Next 4 Years. I now pass on the mic to our moderator, Mr. Ersoy Erkazanji, who is the financial correspondent for Bloomberg HT in Dubai. Mr. Ersoy, the stage is yours.
Thank you, Shuruk. Good morning, ladies and gentlemen. Welcome to the event. I am excited and honored to be the moderator of this first panel. It's a wonderful stage. I have been here for the beautiful lapel show. If you haven't seen this, I advise you to come for this panel. Now we will talk about, as she mentioned, global economic trends and what to expect next 4 years. To be honest, pandemic has showed us 4 years is too long. So we will try to set up the scene, what's happening currently in the financial markets and central banks' life, and we will try to look forward what to expect next. Now I want to introduce briefly my panelists. I have 3 valuable panelists, and if you let me, I'll sit next to them. Now from left to right, Mrs. Khatija Haque, Chief Economist and Head of Research, Emirates MBD. Welcome, Khatija.
Thank you.
Mr. Charles Henry Monchau, Chief Investment Officer at Bank Cs from Switzerland, and Mr. Ahmed Allam, Financial Expert at His Highness, the Ruler's Court, Government of Dubai. Welcome. Now, Khatija, I know you well, but maybe our audience don't you know well. So can you briefly introduce yourself and what you do in Emirates MBD so that we can start our conversation?
Thank you. So as Ersoy mentioned, I'm the Chief Economist and the Head of Research at Emirates MBD. I'm sure I would have met most of you in some capacity or another over the last few years. I've been with the bank for about 10 years now.
Charles?
Yes, hello. So my name is Charles-Henri Monchau. I'm based in Geneva, Switzerland. I'm currently Chief Investment Officer at Bank Cs. So Bank Cs is a rather young Swiss private bank created in 1996. We currently manage $25 billion in assets, and I've been in the financial industry for 25 years, mainly in Europe and Switzerland with companies such as BNP Paribas, Deutsche Bank, or Lombard Odier. I also spent 4 years in Dubai with Dubai Investments between 2016 and 2020. I had a great time, and I'm very pleased to be back in Dubai.
Yes. And Mr. Ahmed?
Yes, hello. My name is Ahmed Allam. I'm working as a financial expert at the Ruler Court, and I get my doctorate in finance, and my research was focusing on the cryptocurrency as the new generation of money and its impact on the monetary system.
As you can see, we have a very diverse background, and we will talk about macro and financial markets and digital currencies. To set up the tone, I want to make a little background. And with the pandemic, we have seen a sudden stop in our lives, also in financial markets and everywhere. But then the central banks and the government started taking actions by lowering the rates and even giving checks to people. Then we have seen a V-shaped turn in the financial markets, and some of the economies are doing well. If you look at Dubai, we are seeing too much traffic and the economy is doing well, but not all the economies are doing at the same level. So I want to start with you, Khatija, and like women empowerment. What's the current situation? I mean, central banks and governments has done a good job, but what's the current situation? What's the next step?
Well, I think it's important to think about how we have ended up in this situation. So the recession last year was, at the end of the day, an engineered recession. Governments chose to shut down their economies for public health reasons, and they then proceeded to inject an unprecedented amount of fiscal and monetary support to allow the economy to recover as quickly as possible when those restrictions were lifted. But the recovery that we've seen is not something which any of the traditional economic models could have predicted, because it's just such a unique set of circumstances. And it's led to a number of dislocations and frictions in the various markets, which have made it quite difficult for policymakers to work out what their next steps should be. So we have seen most of the big economies recover fully in terms of their GDP. That's now largely back to pre-pandemic levels, and in some cases even exceeded that. So it's clear that we don't need the kind of central bank emergency support that was put in place last year. Having said that, there are still consequences in the real economy which have yet to be addressed. So when we look at things like the labor markets, yes, there's a shortage, but at the same time, there's a lot of people that haven't even started looking for work. So there's a number of people who are not even counted as unemployed because they simply haven't returned to the job market. But that is still a measure of excess capacity. And you can't simply ignore those people. You have to also allow time for them to normalize their own situations and return to the job market. We also have a tremendous inequality in terms of the vaccine response. So the wealthier countries have effectively managed to vaccinate the majority of their populations. But when you look at the emerging markets, some of the manufacturing hubs in Southeast Asia, parts of Africa, Latin America, the vaccination rates are still very, very low. And so government responses in those countries cannot be the same as it's been in Europe and the US and the UK. So there's all these different moving parts, and it does complicate central bank policy making because they're finding themselves in a situation where inflation is much higher than I think a lot of the central banks expected. But at the same time, growth is starting to slow, and there are still these pockets of excess capacity in the various economies. What they don't want to do is rush into tightening monetary policy too quickly and choke off a recovery or potentially precipitate another recession. So I think over the next several months, we'll be looking very carefully both at inflation, which most central banks and ourselves still expect to decline next year, and also look at the labor market indicators and see whether people are starting to return to work, starting to look for work, and potentially coming back into the economy.
Okay. You mentioned about the inflation, and before coming here, I was watching Bloomberg International, and there was an interview with HSBC CEO Noel Quinn, and he was saying controlling inflation is a fine art. It's more difficult now, so we will see. Charles, I mean, you feel free to comment on Khatija's comments, but I want you to give more a picture about the financial markets. We see all-time highs in stock markets, in commodities, in real estate. So what's the current situation in the markets?
It's a very strange feeling because indeed, as you mentioned, so the S&P 500 is at all-time high, world equity markets are all-time high, Brent oil at $80, the UAE equity index is up 30% this year, but it feels like investors are still nervous. You know, there is something wrong there. Probably for two reasons. The first one is valuation. We know that you know, most asset classes are expensive, and that makes it nervous. And then there is this inflation story. My take on that is the following: is that we know that the world is in transition, as His Highness said before, but things will probably normalize in the coming years. This inflation story this year, we know that there are some specific reasons linked to COVID, and things will probably normalize in the years to come. And then, it makes me feel also that everyone thinks about the life before COVID and the life after COVID. From a financial market perspective, my view is the following, is that we are still back to this old movie. You probably watched this movie with Clint Eastwood and made by Sergio Leone called The Good, the Bad and Ugly. And I feel that this was the situation before COVID, and it will be the situation after COVID. What I mean by that is that if you look at the global markets overview, the good part is that earnings growth is still there. Despite all of these negative headlines, the reality is that companies continue to deliver. We get strong earnings growth, and we probably have never seen so much innovation in the world. Think about artificial intelligence, blockchain, electric vehicles. It's full of, let's say, new ideas, growth, and so on. So that's the good part. The bad part, and I think we will all agree on that, is that we remain very dependent on central banks. If the central banks pull the plug or just slow down the expansion of balance sheets, we know that markets is in trouble. So the valuation part, if we get central banks slowing down their quantitative easing, then we know that valuation comes in question. So that's the bad part. And then there is the ugly part, which is debt. Remember, back in 2008, there was a debt crisis. It was sorted out with some quantitative easing, and then a lot of quantitative easing. And the bottom line is that we now have more debts than ever. There's debt everywhere, at the government level, also at corporate levels. And debt can create leverage, can create accidents. We have one this year, Evergrande, in China, the debt crisis by property developers in China. That's one example. But given the level of debt, we know that accident can happen. So we still have this spectrum of good, bad, and ugly. But for investors, there is no other choice at the current time, with real rates, real bond yields being negative, than going long risk assets. But the reason they are going long risk assets, but they feel nervous, is indeed because there is some downside risk. So that's my, let's say, 2 cents opinion on the current situation on financial markets. So it should have been time to celebrate, but we are not celebrating because we know that down the road there are still some risks there.
Mr. Ahmed, I want to come to you. Today in the news again there was a phrase like the stock markets are falling because there's an expectation of faster monetary policy tightening. So listening Khatija and Charles, what do you see the current position of central banks? Also, there's a discussion about digital currencies of central banks. What's your opinion about this?
Yeah. Actually, the farther we look into the past, the farther we can see in the future. This is a concept, okay? We all agree that wealth is never destroyed. Wealth is transferred. That's why behind any economic crisis, there is an opportunity. And to transfer this opportunity, to transfer this crisis to an opportunity, we have to know exactly how the global economy works. Okay. The quality of any society is in a direct proportion to its money. The more stable money, the more stable price, all of this will lead to a more stable society. If we review the world monetary system during the last 150 years, we'll find out that world monetary system keeps shifting every 30 to 40 years. If we go back since 1880 till 1915, there was the classical gold standard, in which each unit of the currency was backed typically or backed by an equivalent amount of gold. From 1915 till 1944, there was the gold exchange standard, in which the currency was backed partially by gold. From 1944 till 1971, there was the Bretton Woods system, in which the currency was backed by the US dollar, and the US dollar was backed by the gold. Actually, during this time, the United States get its superpower as a country, as a super powerful country. Mainly, one of the most reasons is the monetary system they are using. From 1971, which is called Nixon shock, the announcement of stop moving or stop transferring any US dollar to gold anymore. So we start to have a new monetary system, which is the US dollar standard or fiat currency standard. Nowadays, I believe that the whole world is going to explore new kind or new era, which is, I call it, the virtual era or the virtual things. Everything going to be virtual. Virtual reality, virtual meetings, virtual works, virtual games, and I believe we're going to have the virtual currency. In other words, we call it the cryptocurrency. The most of the central bank in all over the world nowadays are exploring to have their own central bank digital currency, CBDC. However, many countries all over the world right now have their own central bank digital currency, such as Nigeria Okay, they get already their central bank digital currency. The president of the European Central Bank has announced two years before that they're gonna issue their own central bank digital currency within 3 to 4 years. It means that we are expecting to have the new European currency, digital currency, within 1 or 2 years from now. That's why I believe that we are in the era to have the new kind or the new generation of world monetary system, which is cryptocurrency or digital currency or the virtual currency.
Yeah, I mean, this is interesting. Now everybody is talking about metaverse also, and also I was always complaining that my son was always playing the games, but now I realize why he's playing. Anyway, coming back to central banks, I mean, the discussion is interesting, and central banks was criticized of printing too much money, too much liquidity, and should there be any other options? So I want to hear your opinion about these digital currencies, and also there are discussions that there might be a change in the leadership of Federal Reserve. Powell might change. Would it affect the markets? And almost everybody is following US in terms of decision making. I mean, are there any other central banks that you are following closely other than Fed? I asked 3 questions in a row, by the way. Sorry.
Yeah, I mean, my personal view is very much in line with what Ahmed has said, is I do think central banks are behind the curve in terms of how they are looking at digital currencies, because at the end of the day, that is the way that the world is moving. And if they want to be able to regulate and manage that space, they have to be in that space, and they aren't at the moment. And one of the issues which is being discussed around the reappointment of Chairman Powell or potentially Lael Brainerd, who is supposedly the other option being considered as chair of the Federal Reserve, is that she is actually quite a lot more enthusiastic about a digital dollar and the whole idea of central banks and digital currencies and getting involved in that space. Whereas I think Chairman Powell is a little bit more cautious in terms of what he sees as the potential benefits of the Federal Reserve going down that road. So there is certainly, I think, an opportunity for the administration, if they wanted to shift a little bit the focus of the Fed into potentially what the future of the monetary system will be, then there is an opportunity for them to signal that with the new Fed chair. However, our base case is that Chairman Powell is renewed for another 4 years. That is what the market is expecting. And at this point, when there is so much uncertainty about what's going on, both in terms of the real economy and the financial markets and central bank policy, I think continuity is very important. And if you start to introduce a new leader of the Fed, then the market will have to get used to that person's style of communicating, their forward guidance, and all sorts of other things, which I think makes an already difficult job even more challenging. In terms of what we're expecting from the Fed, obviously they have already started to taper their asset purchases. They recognize that the economy doesn't need as much stimulus. There have been consequences of the stimulus in the terms of asset price bubbles. Some would say housing price bubble in the US as well. And monetary policy cannot be directed, right? It's just putting liquidity in the system, and then it'll kind of find its home. Whereas fiscal policy support can be much better targeted to the people that actually need the assistance, and it takes away some of that fuel for asset price bubbles. So my sense is that central banks, including the Fed, will continue along the tightening route, and that where additional support is required, it will need to come from governments in the form of fiscal support to the affected areas of the population. We do not expect the central bank, the Fed, to rush into raising rates. We think they will take 6 months at least to finish their tapering. And at that point, depending on the state of the labor market, because don't forget, it's not just about inflation, it's about maximum employment. And we're not at maximum employment in the United States yet. If by the middle of next year, the Fed is comfortable that the maximum employment mandate has been achieved, then it makes sense for them to start raising rates. But if there is still quite a lot of slack in the labor market in terms of low labor force participation, then my sense is they would prefer to wait. Obviously, they have to balance the risks around inflation with the risks of tightening too early. And we can talk a bit about inflation if you want at some point. Yeah.
Charles, I read your note about Goldilocks and three bears, the famous story. I mean, if I am not mistaken, three bears are China, inflation, and policy risk. You want to elaborate on this a little bit, your note?
So you asked me about these Goldilocks and three bear stories. Yeah, indeed. So that's it's the time of the year to write investment outlook. So indeed, we already wrote our investment outlook, and we're thinking about let's say a title to kind of summarize the current situation. And indeed, we called it Goldilocks and the faces of three bears. And if you haven't heard about this story, it's basically about Goldilocks is really having, let's say, the best of two worlds, in the sense that when you look at growth and inflation, for financial markets to be, let's say, in good shape, you need to have some growth, but not too much growth, and some inflation and not too much inflation. And this is basically what we are foreseeing for next year, is normalization of growth and normalization of inflation. And the three bears, you mentioned, indeed looking at the risk the macroeconomy might face next year. One of them is China, because we can see that US is currently doing very well, but China is decelerating probably more than expected. There is probably, let's say, some things to do with the Winter Olympic Games, where they need to have, let's say, clean sky, so they need to kind of cool down on some activities, but still the slowdown is meaningful, so that's one risk. The other risk is inflation surprising on the upside. Although we believe that inflation will normalize, you never know, especially with energy prices. What if, oil prices, for instance, spike above $100 or $120? That will probably, let's say, make inflation higher than expected. And the third risk is miscommunication by central banks. As I referred to before, we know that financial markets are addicted to central banks. So if there is any miscommunication, if there is any panicking by central banks, this will create some risk. So that's why we have this Goldilocks faces the three bear situation. I just want to come back on the question on digital assets and cryptocurrencies, because I think one of the lessons of 2021 has definitely been a year which is a breakthrough year for cryptocurrencies. Think about it. First time ever that the market cap is $3 trillion. Returns have been triple digits. We heard about NFTs, we heard about DeFi. It was the year of the IPO of Coinbase, so we see all of this institutionalization of cryptos. I can tell you in Switzerland, all of the Swiss private, well, not all of them, but at least 2 out of 3 Swiss private banks are currently looking to offer some kind of solutions around cryptocurrencies. Will it be custody? Will it be trading exchanges? So it's really a year where things are moving. And when you think about it, because maybe many people are saying, well, $3 trillion for cryptos, that's crazy. It remains still a very small part of the global total assets portfolio in the world. It's probably less than 1% of the world global assets. And our view is that if you take a long-term view on that, probably in 3 to 5 years' time, the number will be higher. We believe that the blockchain innovation parts, all of the innovation that blockchain and cryptos are bringing to the world are currently underestimated. There is a misunderstanding on that. And the other big misunderstanding is that many people say, okay, I understand blockchain, I think it's good, but I think cryptos, this is just a scam, this is just speculation, I don't get it. I think there is also a big misunderstanding on that, is that cryptos and blockchain are intertwined. And if you really believe in blockchain, then you need to believe into cryptos. And again, it's maybe a risky bet, risky view, but we believe that 3 to 5 years' time, let's say the size of the pie will be higher. There will be some losers, like the internet, you know, like think about it like an internet bubble. Many companies disappears. The same with cryptos. Many cryptos will disappear. There will be only a few, let's say, big survivors, but the survivors, you know, will take a disproportionate share of the pie and will thrive. So there is, on our side, which is a bit controversial, but that's the bet we take, a positive view on cryptos, you know, looking forward.
Oh, yes, also Ahmed, I want to ask you this crypto assets, I mean cryptocurrencies, NFTs, or other all things around it. I mean, is it growing and are they now in the traditional asset class? What do you think? And also I want to add you also, Charles, when I go to events now, I started feeling like a bit old because the people who are going there, they are not wearing suits or ties, and they are wearing t-shirts and more different styles. Even the lifestyles of, I don't want to like separate them, okay, crypto guys or startup guys, but there should be a link between, let me say, traditional finance, CFI, DeFi, and other people. But now I feel there's a difference even in the events and the lifestyle of the people.
Okay, let me, before I proceed about the cryptocurrency, let me define exactly what is the characteristics of the currency. We will find out that the characteristics of the currency is that it's portable, divisible, fungible, okay? Yeah. But the money characteristics are all of these, plus it's a store of value. This is the key word of the real money. It has to be store of value. During the period of 1944 till 1971, the ounce of gold was equal to $35. Nowadays, the ounce of gold is equivalent to approximately $2,000. It means that this is not a real money. The real money has to store the value. Going back again to the cryptocurrency, actually it's called the cryptocurrency. I agree with this word, but it's not a crypto money. It's a cryptocurrency, and it's a solution for what we have nowadays, but it will not be the perfect solution for our monetary system problem, because it cannot guarantee to store the value of things. Okay. Anyway, I have been asked many times how the people can trust the cryptocurrency or Bitcoin, for example, since it is the first cryptocurrency we ever have nowadays. My answer is very simple. Bitcoin gets its trust from the fact it doesn't need trust at all. This is the key word why the people are trusting Bitcoin nowadays. Bitcoin is relying on an open source code, which means the holder of the Bitcoin dealing directly with the system. No need for intermediary to deal with this currency. Other reason that this Bitcoin is relying on the blockchain technology. This blockchain technology guarantees an on-time updating of the transaction to guarantee that the ledger, the distributed ledgers, will be the same in all devices for all the holders of the currency. It means no need for intermediary to do this business, to update the system of all the transactions. Other reason that the cryptocurrency or the blockchain is uncentralized system, which means no one control it, no entity control it. So we rely on our currency nowadays based on our trust to the central bank. If we lose the trust to central bank, we will lose the trust of our currency. It's the same. Nowadays, cryptocurrency don't need any entity to trust in it. You are trusting in the system directly. So this intermediary, this elimination of intermediary gives the courage for some people to trust in this new technology or to trust in this new kind of currency as a solution for what we're having nowadays for our current currency. This is my opinion. That's why we're talking about the speculation characteristics of the cryptocurrency nowadays. It's true. Nowadays, the cryptocurrency in general are based on the speculations. But within the next few years, it will move from this speculation to be like an electronic monetary system, which it was promised to be since it was innovative since 2009. So I believe sooner or later we will going to have this new kind of currency to deal in our daily on our daily basis, instead of the currency we have in our pocket, or instead of a credit card which we have to use in performing all of our transactions.
Okay.
Sorry, can I just add
Yes, please.
something to what Ahmed mentioned about? Yeah, it's okay?
That's right.
Just to add to what Ahmed mentioned about decentralization and the trust of the Bitcoin network. If you think about it, June 2021, China decided to shut down Bitcoin mining in China. Okay, that was June. That means that 35% of the mining in the world was asked to shut down from one day to another. We haven't seen one single issue in terms of the Bitcoin network, the Bitcoin protocol, during the time where 35% of the mining moved to China, from China, sorry, to US or Kazakhstan. Not a single issue. So I cannot think about, let's say, traditional financial industry. If you ask, 35% of the banks worldwide to put, the key, under the door, and without having any issue in the system. So here we saw the power of decentralization. You can have one country asking all of the mining to shut down, and the day after, it still works. And I think that was a key event of the year in terms of blockchain and crypto. But more than that, because that was a big surprise to see that it really works. That was proof in the pudding, as we say, and I think it gives credit to the strength, the robustness of the network and the protocol.
Okay. Khatija, I'll come to you, but Charles, I want to ask you, you have lots of clients globally. How is the trend in asking cryptos, or are you offering them any products in crypto assets?
Yeah, so it's interesting to see the difference in demographics, because it's true that for most people who are, let's say, 60 years and older, they don't want to hear about it. They compare it to the tulip mania. They say it's purely a scam, it's pure speculation. So they are very skeptical. And then you look at the millennials, or younger, and then they have, let's say, very large allocation to it. So let's see, going forward how it's going to move. But the reality is that if you look at the US, for instance, we know that now the large US banks are offering custody of Bitcoin and other cryptocurrencies. And it's moving, from the US to the UK to Europe. And here I know that the UAE is really, very early very early compared to the other country in the process. And probably it will move here faster than elsewhere. But there is definitely, let's say, a request for having access, directly to cryptos. Another request, in Switzerland is very basic, but you have some, let's say, millionaires and billionaires in Bitcoin in the world, and they want safety. So they want to find, let's say, a safe custody for the Bitcoin, and that's a big issue for the Swiss banks, because to be able to guarantee that your keys, are safe, and insured within a Swiss private bank vote. Would it be, let's say, a digital custody, or let's say a normal custody? That's not the easy thing, but I can tell you that the large Swiss private banks are currently working on a solution like this to offer very safe, custody of your Bitcoin keys. So yeah, there's definitely a trend on that.
Khatija, you want to touch on crypto assets, or I can ask you at more traditional sector, oil prices, which is also exciting nowadays. The current prices today, it was a bit lower than $80, but it is still very high when looking at the people's expectations in the beginning of the year. There will be another panel about Middle East, but when you look at the overall macro, these high oil prices or high energy prices, not only oil, now natural gas, even iron ore, how is this affecting the global macroeconomy?
So I think it's safe to say that energy prices have been the main driver of inflation globally this year. So in the US, it's by far and away the biggest contributor to the 6% headline inflation that we are seeing at the moment. And there are a number of reasons why oil prices are high at the moment. You know, everyone is aware that the issues around liquid natural gas in Europe, there were disruptions to supply, there were weather issues, it was, again, a fairly unique set of circumstances which has contributed to a shortage today. But there is actually very little expectation that that shortage is going to continue beyond the first quarter of next year. So whether you look at the IEA forecasts, OPEC's own forecasts, even you know, the US, and there was discussion about releasing crude oil from the strategic reserves, they decided not to do that because their own advisors basically said this is a short-term issue. And as soon as we move into the you know, first quarter of next year, the demand will slow. And supply is going to continue to rise, both from within OPEC Plus and also non-OPEC producers as well. So actually, we're looking at a situation where as we get into the second half of 2022, we may very well find ourselves with an excess supply of oil in the market and downward pressure on prices. So when you look at what is going to drive inflation next year, we actually think energy prices are going to become deflationary in the second half of 2022. And that's one of the reasons why we expect inflation to moderate in the second half of next year. So, you know, our view is that, yes, prices could go as high as $100 a barrel. They could go a little higher even just in the near term because of the supply and demand issues today. But when we look further out, and certainly when you look 20, 30, 40 years out, as the world is moving away from hydrocarbons as a source of energy, the probability is that oil prices will be significantly lower than they are today. So this is not something which we believe is going to be a problem in terms of driving inflation, you know, for an extended period of time. This is very much, in our view, a relatively short period of time, and OPEC countries are making the most of high oil prices to support their budgets.
Every day I report about oil, and today there was a news about US using strategic petrol reserves and in a coordinated effort. I mean, yesterday the news was they talked with China, and today they asked also to South Korea and India to coordinate it together. But we will see. I mean, I don't know if they are going to use the reserves together. So any comment about oil prices and well, how do you see and how is it affecting the economies, Charles?
Well, the reality is that supply demand situation remain, we know, in imbalance. So we have seen inventory coming down to the 2018 level. So that means that any accidents can create some spike in oil prices. We saw with the hurricane in the Gulf of Mexico, you know, very recently. Any weather or any geopolitical situation can put some pressure on the oil price upward, and that remains the wild card for next year, because that's not something which can be sorted out like the other bottlenecks. You know, when it comes to transport, this is something that, you know, after some time, governments or companies can fix. The same with labor. We know that labor is coming back to, you know, to work, so that's, you know, should, you know, bring down some of the pressure on the labor supply. But energy prices is not something that governments or central banks can do anything about. And we know that if, you know, oil price spike next year, that will make the life of central banks very difficult. But again, if we look at 2022, I think, you know, supply demand should come back into, you know, some balance at some point. We also know that nowadays, if you look, for instance, at the US, there are much, you know, the consumer is much less sensitive to oil prices than it was 20 years ago. But still, you know, it will depend. We don't know exactly, you know, where is the, let's say, price level where it really start to hit, let's say, the consumer. What was interesting is that we have seen recently some consumer sentiment survey saying that the consumers start to get nervous, but we also saw retail sales last week going to the roof, so it looks like they are not really doing what they say. They might feel bearish, or let's say cautious, but actually they spend. And it's probably due to the fact that there is still a lot of savings, and this can protect, let's say, the health of the consumer next year, the fact that there's still a lot of savings. But again, if oil price moves to $120, $130, it probably can create some issues for central bank and for the global economic recovery.
Mr. Ahmed, I was in ADIPEC 2 days ago in Abu Dhabi Petroleum Conference, and it was packed. I mean, maybe because of the oil prices, but also climate change and other things. Do you want to comment about oil prices, or also in this event I have seen digitalization in energy? I mean, we see digital transformation in every sector. You want to comment about, digital transformation and using it in different sectors?
Yeah, but let me just actually focus on the prices. You compare price with what? You have product. You compare the price of what? With the dollar, with the yuan, Chinese yuan, with euro. Actually, this is not proper comparison. I will get this from the American Constitution. In the American Constitution, say in the Article 1, Section 10, that the money is nothing other than gold and silver. So if you're going to compare the price of any product, you have to compare it with gold and silver. Don't compare it with paper, because actually it will not give you a real comparison. Okay? That's why if we review that the price of the gold, it keeps changing compared to the dollar. It keeps changing compared to the euro, and so on. But if we compare make a comparison between gold and oil, for example, it will give a logic comparison. Here is the real comparison. Here you can say the price is going up or the price is going down. Okay. But if I'm going to proceed about this, so I have to take it from the higher level, which is the inflation, if you allow me to talk about it. Okay, if we talk about inflation, most of the people think that inflation is a function of the currency supply. It's correct, but it's not accurate. Because in fact, the inflation is partially a function of money supply, while the other part of the function of the inflation is the consumer behavior. This consumer behavior leads to something called velocity. Velocity is measuring the number of times each unit of the currency, it changes hands. To simplify it more, let me give you an example that there is a country has a currency supply of 1 billion, and it has a velocity level of 5 times. It means that this country has a GDP of 5 billion. But if the same country has a currency supply of 2 billion, which is double, and it has a velocity level which is 2, the GDP will be 4. The conclusion is that the higher velocity level is much important for the currency more than the currency supply it has. Unfortunately, what we are doing, instead of controlling the currency supply in our society, we are doing the opposite. We are expanding the currency supply in our society, not only by printing new currency by the central bank, but by expansion of issuing leverage, expansion of issuing credit card, the expansion of using the derivatives such as options and future contracts, the new issuance of cryptocurrency. All of these are leading to increasing the currency supply. This currency supply will affect directly to the level of inflation in our society. That's why our society is based on the debts. Our society nowadays is based on the debts. That's why I believe that the world is going into default, since what it owes less than what it could pay. That's why I believe that we are going to have some kind of super inflation. I'm not talking about hyperinflation. I'm talking about super inflation, because hyperinflation is very rare. very little country has experienced or had experienced hyperinflation, such as what happened in 1920s in Germany and what happened in 2007 in Zimbabwe. But I'm talking about superinflation, which inflation rate between 10 and 20 or 30% during the coming few years.
By the way, I think we are out of time. Then, if you give me 2 minutes, I want to have your last words. Tell us what should be the key take message for our audience, I mean, for them to remember from today.
I think we cannot be too complacent about COVID. It hasn't gone away, and there is still potential for disruption next year from the virus and from policy responses to it. I think the era of free money is on its way out. Central banks are going to gradually withdraw stimulus, and it will lead to disruptions in financial markets. But I'm much more optimistic on inflation. I think a lot of the issues around inflation are coming from strong demand and supply not being able to keep up. But we know that where there is opportunity, people will invest, companies will invest, and the supply chain issues will be resolved. The demand will slow, and we will get to a point where there is a more normal equilibrium, and prices will moderate. So I'm not overly worried about inflation at this point. Yeah.
Charles, in a short way.
Key message, yeah. A key message is the following: is that I think most of the governments cannot afford to have real bond yields going up. So there is still lots of debt, lot of, let's say, fiscal deficits. So they cannot afford to have real bond yields turning positive. So real bond yields are going to stay negative. Look in the US, 30-year bond real yields is negative, minus 0.6%. So you have no other choice than to look for investment opportunities. And the good news is that there are lots of investment opportunities. As mentioned, it's a world full of innovation, new trends, disruption. So, as investment professional, I think our job is to find these winners and losers and go into the best opportunities. And this is indeed the good news. Yes, it's a world in transformation, but that creates a lot of opportunities for investment managers.
Thank you, Charles. Dr. Ahmed?
Yeah. Actually, I think it's the time, unfortunately, our economy is acting like it has the boiled frog syndrome. I think most of us know about the boiled frog syndrome. That's when you put the frog in the boiled water, when it's hot, it goes directly outside the water. But if you put it in normal water and keep boiling this or increasing the heat of the water, gradually there is no action or no reaction from the frog. This is the same of our economy. Our economy don't do nothing regarding the change, just keep tailoring itself till it go to the maximum level of the bubble. And what happening at the end? This bubble is burst. It doesn't go gradually again how it's going up. That's why we have to take a severe corrective action. I believe that it's the time to keep controlling the currency supply, which we keep doing it nowadays by different ways, by the increasing usage of leverage, increasing usage of derivatives, increasing usage of credit card. I think it's the time to organize it in a proper way and going back again to put a backbone for our currency with a real assets. We need our currency to be backed with a real assets. That's it.
Thank you, Ahmed. I want to thank you, to audience, and to my panelists. Thank you, Khatija. Thank you, Charles. Thank you, Ahmed. Thank you for listening us. I hope you had some good insights about the global macroeconomy. Thank you.